In this lecture, we're going to be looking at performance evaluation. We're going to be using budgets like we learned in prior lectures, but we're also going to be comparing them to reality. By comparing what we expected with what really happened, we can get an idea of the level of performance the management is doing. Are they doing a good job or are they doing a bad job? Well, if you take what you expected, aka the budget, and compare it to what really happened, then you can get a feel for their performance. They call that a performance evaluation. There are two ways to approach decision making with a business. One is a centralized approach. This is a top-down approach in which one of the main managers or owners of the business will make all the decisions and pass them down to the other people. Usually this is a smaller business where there's a single individual that can understand every aspect of the organization. However, with larger organizations, that becomes very difficult for one single person to be an expert and to understand everything that's going on. In a decentralized approach, the business is broken up into different pieces. How are these pieces broken up? Well, you can have it broken up based on geographic regions, your North Division, South Division, East Division, West Division. You can have it broken up by product line. We have our sporting goods division and we have our juniors division. Based on distribution channels, for example, you might have sales in the actual store versus sales online. That would be a distribution channel division. You might have broken up based on the customer base or the business function. A business function such as accounting department versus human resources department. Those are just ways to break the business up into different chunks and give each management team their own piece of it. This is what they call the decentralized approach. The advantages of the decentralized approach is that you have the ability to use expert knowledge. Managers are usually put into areas in which they are experts. Rather than having to know everything about the business, they only have to know about the area that they're an expert in. You might have customer and supplier relations that are more clearly understood when you're decentralized. For example, you might have your management team over the state that they're in and they understand the culture of their state. It's easier to train in this kind of a situation with decentralized breakup because a decentralized structure means you can train in a very specific area. And it's good for retention and for motivation because people tend to like a certain area of business. And so they get to do what they like to do. Now there are disadvantages, and one of that is duplicate cost. For example, if you have a North and a South division, each division might need human resources, and so that kind of duplicates the cost that you have. And then they have what they call lack of goal congruency, and that's not a good thing. Goal congruency means that the goals of the managers line up with the goals of the organization. So if the management's goals are similar to the business's goals, that's goal congruency. But when you have a decentralized organization, there tends to be a lack of goal congruency. You may want what's good for customer service because you're the customer service manager, but that may not necessarily be what's good for the entire organization as a whole. An effective performance evaluation system basically just means how we grade our managers. So a good way of grading managers would be to provide them with clear expectations. They understand what we are looking for them to do. We don't have vague expectations. If you say just do a good job, that's not very clear. But if you say you want to cut costs by 10%, that's much more clear. Another thing that would be part of a good, effective performance evaluation system would be good feedback. Did you do a good job? Here's why you did a good job. Here's why you didn't do a good job. Give them good feedback. Give them benchmarks. So benchmarks are set standards that they have to meet. If they have benchmarks, then they know what kind of goals they need to attain. An effective performance evaluation system is good for motivation. It leads to employees being motivated to not only improve their jobs and their performance, but to improve the organization as a whole. An important part of the evaluation system is called responsibility accounting. And that's basically evaluating the management based on what the managers can control. If they can't control something, then they shouldn't get graded on it. They shouldn't get an evaluation. For example, if they can't have any kind of control over the property taxes that are assessed on the company, then why would we want to evaluate them if the property taxes went up? That had nothing to do with their performance. But if they are evaluated on the efficiency of their labor force, then they have control over that. That's a good thing to evaluate them on. So responsibility accounting is evaluating based on what the managers can control. Most businesses have an organizational chart where you have more responsibility at the higher levels. What I mean by that is that the higher level, for example, the CFO, has more control over multiple parts of the business than the manager of customer service. So the customer service manager's responsibility accounting, what they have control over, is going to be much different from what the CFO has control over. If you gave the bonus to the CFO based on profits of the entire company, that might make sense. But if you told the manager of customer service that her bonus was based on the profits of the entire company, that might be frustrating because she can only control customer service. So the higher up you go, the bigger the umbrella is that you have of control. Responsibility accounting leads us to what we call responsibility centers. In each responsibility center, the managers have specific control over what they're going to be held accountable for. A cost center, the manager is only held responsible for the cost or spending of that area. A revenue center, the manager is only responsible for what sales revenues they bring in. Profit centers, the managers are responsible for how much profit is left over when they take the cost away from the revenue. Cost minus revenue equals profit. And the investment center means what kind of percentage return they have on the investment of the assets in that part of the business. So a cost center would be, for example, the human resources department. The manager there would probably only be held accountable for how much he or she spends. You don't really bring revenue in through the human resources area, so it would be silly to evaluate the managers on revenue they bring in since they don't bring any. But they're probably given a budget to follow for how much they can spend, and that's why it's usually a good idea to make those kinds of departments into a cost center. A revenue center is usually for the sales or marketing area. And in this case, what you're looking for is how much revenue the managers bring in. Just the revenue that they're bringing in, not the cost, the profit, or anything else. Just how much revenue they bring in. Let's look at an example. First, we'll look at an example of a revenue center for the sales departments for the different products that we have. Our business sells chips, beverages, and candy. So what we'll do is we'll compare the actual sales with what the budgeted sales were. So they had a budget to bring in X number of sales. What really happened? So we'll get that information from the given information. Once that information is provided, then we're going to look at what we call a variance. So a variance is the difference between what the actual sales were and what the budgeted sales were. Think about it like this. You want your actual sales to be higher than your budgeted sales. You want more sales than what you expected, right? So that's what we're looking for in our variance, to see if we are above or below the budget. For our first product, the chips, the budgeted sales were $2.4 million, but see, we only brought in actual sales of $2,348,000. That's a variance of $52,000. We call that an unfavorable variance. We don't call it a negative or positive variance because that can be confusing. We'll see why that could be confusing when we look at expenses. But if we say we have an unfavorable revenue variance, then we know that that means the revenue didn't meet expectations. So we put U for unfavorable. And we'll do the same for beverage and candy. Notice for the beverages, they made more in sales, $154,990, compared to $150,000 for the budgeted sales. That's a favorable. That's why there's an F there next to the variance. That's favorable. But the candy was below the budgeted sales. That's unfavorable. So by using favorable and unfavorable, it's clear whether or not we met our expected budget in sales or not. What we might want to look at is the percentage difference rather than the dollar amount. We see that the chips have a variance of 52,000 and the candy has a variance of 63,031. So those variances in dollars are kind of similar dollar-wise. But when you look at the percentage difference, we see that the candy is a much bigger percentage. When you look for large percentage variances, they call that management by exception. In other words, what they're saying is that if something is a big enough difference, then we want to investigate it. But if it's a small difference, we don't need to investigate it. It doesn't matter if it's favorable or unfavorable. If it's a large enough variance percentage-wise, then we would go ahead and investigate it. Usually management looks at something like 5% variance as something they would investigate, although that's really up to the management team to determine. The calculation to get these variances as a percentage would just be to take the actual sales minus the budgeted sales and then divide by the budgeted sales. When you do that, that's how you get the percentage. And then you know if it's favorable or unfavorable based on if the actual amount is higher than the budgeted amount for sales.